What does CVP stand for? CVP? Cost, volume, profit. Which one is the goal? Profit is the goal. What is B? Yes.
It's the variable.
It's a variable, it's a decision variable, right? So it's a variable, and what about C? What kind of role does C play? That's the constraint, right? So that's the, okay, that's what you have to, make up. Alright, so just putting it right here, alright, so, contribution margin per unit times units minus fixed expense, right? So P is here, that's our objective, volume, volume right here, and C is right there, alright? So, this is actually a very useful frame, okay? So, I think a few years ago, maybe just two years ago, I saw a comment by Elon Musk. He was commenting on his competitor is producing the electricity car. So one of the comment is, well, so his competitor at the time was boasting like how many cars they actually produce. And his comment is, well, so if your contribution margin per unit is negative, right? So this is important, right? How do you calculate contribution margin per unit?
Sales price minus variable cost.
Selling price per unit minus variable cost per unit, right? Variable expense per unit, right? So if you can make this positive, doesn't matter how many units you produce, right? So sometimes, people will think, well, so as long as I can sell, right? So as long as I can sell my product, eventually I'm gonna make a profit. Not necessarily. That only true if your contribution margin per unit is positive, right? So you have to think about, well, so how much is your variable expense? If your variable expense is higher than your selling price, doesn't matter how many units you're gonna sell, you're not gonna make a profit. So that's a very important, powerful, things to think about, so you need to, so pay into, so it's not, sometimes the decision frame, how you frame the problem is actually important. All right, so we talk about two applications, so the break-even, the sensitivity analysis. I wanna move on to break-even for multiple products. So many of you already know how to do break-even, but when we do break-even, usually we treat that as one product. All right, so what happens if we have multiple products, right? So the trouble is the overhead, the fixed expense, you cannot separate, so what portion of fixed expense is for product A, what portion is for product B. So if you can do the complete separate, so then it's okay, you can just use whatever, we did, last week to calculate the break even. But then when you kind of mingle together, so this is a big pile of fixed expense for multiple products, right? So company usually have more than one product, and then this will become an issue, So how do you know, let's say you have a coffee and cream, right? So how do you know, in order to break even, how much coffee you have to sell and how much cream you have to sell, right? So how do you calculate that? So then we're gonna look at, so there's an easy way to do this, and there's a harder way to look at this. So the easy way is, if the manager said, well, so help us to determine the break even in sales. I don't care, exactly how many units I'm gonna sell, I'm gonna produce. As long as, this is how much sales revenue we have to generate, then we can break even. This is the easy one, So you don't have to, but the harder one is actually more informative, more useful. So let's look at the easy one. So to do this, so the easy problem, we look at the sales, all right? So how much revenue we have to generate in order to break even. I don't worry about, okay, do I have to produce, okay, certain, okay, quantity of coffee or cream. Now, in order to do this, well, so we get, I always, okay, call this as contribution margin per sales, okay? So multiply by sales, right? So instead of calling this as contribution margin ratio, you can reframe this as contribution margin per sales, multiply by sales revenue, that's okay, equals a fixed expense, then you can get your break even in sales. Now, the information we need, okay, to solve this problem is also easy. You just look at the company's income statement and then rewrite this into this contribution margin income statement. By the way, this is not an easy task, okay? Okay, to go from the traditional income statement and reproduce this is not easy because you have to identify the variable COGS, variable, okay, operating expense, and then you, okay, fixed COGS and fixed operating expenses. So there will be a lot of adjustment you have to make. All right, so now given we can do this, all right, so which we bypass this. Now this is what we have. All you have to do is, well, so I'm calculating contribution margin per sales. So then that will be, by definition, 276 over 690, all right? So I don't know what that is.
0.4.
That's 0.4, okay? So this is basically 4 cents per sales, all right? So then your break even. So break even in sales will just be fixed expense divided by, so 180 divided by 0.4. Okay. So I don't know, it's a 45, 450, right? 450, so that will be your break even. Pretty simple, right? So let's say the company actually have 10 different products. But then, okay, think about this, okay? So if you tell the manager, as long as you can make sales 450, you can break even. It's not very useful because the manager has to go back and then arrange the production and everything. So suppose you have 10 different products. Okay, so how are you gonna know for product A, how many units I have to sell, product B and product C? So how do you know that? So this is basically can give you some kind of guideline, but it's not very useful in terms of production. So this is why, okay, we are gonna, okay, address the difficult problem, all right? So the difficult problem is, well, so we need to figure out the break even in units, okay? So especially when we have multiple products, okay? So that's basically, well, so this is, okay, very common mistake. People just treat this as if this is one product. The idea is kind of similar, but then if you directly use the formula to calculate the break even, and you won't be able to do that. All right, so now let's, okay, so the basic assumption we're gonna use is the constant sales mix. So the sales mix basically means the percentage, or the, okay, you can use percentage, you can use, okay, so some kind of definition to define the sales. So you can say, okay, every 10 coffee, every, okay, 10 donuts, and then I sell, okay, 1 cup of coffee, right? So that will be, okay, the sales mix. You can also say, well, so for all the sales we have did, okay, 60%, okay, comes from donut and 40% comes from the coffee. You can do that, right? So it's, so there are multiple different ways to, okay, define sales mix. Now let's see how we are gonna address this. Now the key thing is always try to, okay, reframe the problem. So today's thing is, okay, let's, okay, try to make sure we frame the question correctly, okay? So to reframe the problem, okay, the multiple product into single product, so that we can apply the formula. We can do as what we did last week, and then we are gonna unpack, okay, what we, okay, the reframe, and then try to figure out how many units we have to produce for each of those multiple products. All right, so let's look at this question and see what we can, okay, implement that strategy. So let's see, okay, the fixed expense is 180. All right, so we have product A, product B, sales mix. All right, So it's basically every 3 units of A, we sold, okay, 2 units of B, alright? Then we have price, we have, okay, variable cost. Okay, naturally, I'm gonna, okay, calculate the contribution margin per unit. So then that will be, okay, 4, 10 minus 6, A minus 5, that's 3, okay? Alright, so the step, okay, we're gonna do is, so following this step. Okay, so we are gonna define a package. So this package is basically our reframe. As if, okay, instead of selling individual A and B, we are gonna put A and B in a box as a package. And then we are gonna, because we are gonna keep the same sales mix, so that's as if, okay, we are selling one single product. Okay, so that's, okay, the package. Then we're gonna calculate the contribution margin per package, calculate the break-even in package, and then unpack. Alright, so there are 2 ways to package. So 2 ways to pack. Okay? So to pack A and B. Alright, so one way, the first way is one package equals 3A plus 2B. So that's very intuitive, right? So I'm putting, okay, 3 units of A and 2 units of B in one box. Then that will be every time, okay, any customer wanna come and buy the product, they're gonna buy the package. Another, okay, so way to explain is, okay, one package is 60% of A and 40% of B. So where do I get the 60%, 40%? So that will be basically 3 plus 2 is 5, so 3 over 5 and 2 over 5. So that's where the 60%, 40% coming from, okay? So you have 60% of A, 40% of B. Alright, so which one do you feel easier? Which one do you prefer?
This one.
The second one or the first one?
First one.
First one. Okay, we do first one, but then don't worry, I'm gonna show you how the second one works. So this one, okay, in the doghouse. So I'm going, okay, for the first, okay, so 3A and 2B, alright? So that's the first step. And then the next one, I'm gonna, okay, calculate the contribution margin per package, alright? So then that will be 3 units of A, that's a 4, and 2 units of B, that's a 3, alright? So this is basically 3 times the contribution margin of A plus 2 times the contribution margin of B. We okay? So that's 12 and 12 and 6, so that's 18. Okay. Alright, and then, okay, so then we will calculate the break even in package. Okay, so in packages, so then that will be the total 180, okay, divided by the contribution margin per package. Alright, so then we have 10,000 packages. Alright, and then we will calculate, okay, so now we are gonna unpack. So once you know, okay, this is how much, okay, package we have to sell. So notice, this calculation is legit, because now we get back to the one product setting, right? So instead of having multiple products, we have, so 180 for one product. Okay, the product is the package, the contribution margin is 18. Okay, so then to unpack, so 10,000 times 3, that will be for A, so that's a 30,000 A, and for B, that's a 10,000 package, each package have 2 units of B, so then you get 20, alright? So that's A and B. Alright, so now I wanna, okay, double check, right? So to check, okay, so if you do the calculation, if you wanna double check, so you have, okay, so the sales, I have 10 and 8, so I have 10 times 30K and 8 times 20K. So that will be 300K, so, okay, so 160K, so that's a 460K. Alright, and then we have the variable, so variable expense, so I have 6 and 5, so 6 times 30K and 5 times 20K. alright, so that's 180, so that's 280, alright? So 280K. So now contribution margin is a 460K minus 280K. That's exactly 180K, right? So which is the same as fixed expense, right? So minus fixed expense, 180K. So then I get profit, so operating income equals 0 here, right? So that's checked. So, okay, always, okay, when you have, sometimes the question is not clear. So when you have, okay, multi-product firm, if you are not sure about your result, you always go back and check. Okay, so do the revenue, variable expense and fixed expense, and make sure your operating income 0. So that will be one way to check, okay, make sure your calculation is correct. Alright, so now, okay, so this is just one way, okay, so another way, if you do the package, okay, that's a 60%, 40%, okay, the way you calculate the contribution margin per package is different. You just have to be consistent, 60% time contribution margin for A plus 40% time contribution margin for B. And break even calculate the same way. Notice you get the different, okay, break even in package, that's 50,000. Now when you unpack, again, you're gonna apply consistently, 60%, 40%, all right? So as long as you do this consistently, you should get exactly the same result, doesn't matter, okay? All right, so things we are in, okay, we are talking about the practical, okay, so problem. So now, here is another, okay, so this is just, okay, when you, okay, so in your office and then do the calculation, you got 30 and 20, right? So, but in reality, we know, okay, we also subject to how many units we can sell, right? So sometimes the marketing department will tell, here is the market demand, right? Even you think, okay, you can produce this to break even, but the market says, no, you cannot sell certain, okay? So certain, okay, to a certain amount. So in this case, okay, so the market demand will impose upper limit, right? So how much, okay, how many units the most you can actually sell. So in this case, okay, what are we gonna do? So let me, okay, continue give you this more information. So suppose the marketing department says the maximum you can sell for A is 25, for B is 38K, okay? So those are the number from marketing department. All right, so first of all, we calculate 30,000, 20,000, if this is feasible. It's not feasible, right? It's not, which one, okay, is a problem? A is the problem, because B, we get 20,000, we can sell more than 20,000, B is fine. A is a problem, because the most we can sell is 25. So A is a problem. Alright, so that's why, okay, so not feasible. Okay, so this is basically, okay, the first thing, no. Okay, so then, if it's not feasible, it's not a good plan, right? So you have to go back and revise your plan. So what can we do? So this is basically, okay, what the things you can do. So instead of thinking about the sales mix, like fix the sales mix, and this is, okay, you can alter the sales mix. So the way you do this is, well, so the contribution margin for A and B doesn't change, but you look at all different ways of sales mix, okay? So 10, 90, 20, 80, and so on. So you calculate the contribution margin per package, all right? So then, okay, based on the sales mix, all right, so then you, okay, this is a fixed cost, and you calculate a break-even in package. And then you, okay, then you allocate, right? So the things you do is basically, for instance, okay, how do I get this, right? So how do I get the contribution margin per package? So that will be 20% times 4 plus 80% times 3, right? So that's how I get 3.2. Then I'm using 180,000 divided by 3.2, then you get a break-even in package. Then once you get the package, okay, 20% goes to A, 80% goes to B. Okay, so that's a 20% of this, that will be A, 80% of this, that will be B. That's how you produce this table. Now, with this table, you can go as detailed as you want, okay? So now, okay, I'm looking for the maximum, the additional information. So this is what the marketing said, 38, right? So anything below this will be feasible, correct? So which means all this will be feasible and all this will be feasible, right? So how many feasible plans do we have? So that will be okay. Those three will be the things you can suggest to the manager, right? So then the manager said, so instead of look, okay, 30, 20, so this is outside, right? So those are not feasible, but only those three will be feasible because you have to make sure both A and B are feasible. So that's okay how you incorporate additional information in your break-even analysis. Okay. We okay? Question? Very intuitive, not so hard, but you need to have a little bit thinking going on. All right, so now I want to move on to risk analysis. So when we talk about CVP, that's basically decision making for the next 12 months, right? So when we start making decision about the future, there's always something we do not know about the future. So that's uncertainty, right? So there's something you don't know, that's uncertainty. So uncertainty doesn't mean it's a risk. But when something you don't know actually affect how much profit you can generate, then that will be so that will be a risk. All right, so so the large company usually so when you use the CVP, usually you will think about break even. But I'm gonna talk about there's another side which is less known. It's on the risk analysis. All right, so when we talk about risk, right? So because the future can be good or bad. When it's good, then that's upward potential, right? So that's something we can brag about, right? So look, next year we're gonna so increase our sales by 20%. That's something you can brag about. But there's also a downside. So because the future cannot be is uncertain. So if you can be good, it can also be bad. So there are always two sides. So you can see the future, the sales can be increased by 20%. It can also decrease by 20%. When the sales decrease by 20%, that will be the downward risk we worry about. So now, CVP actually give us two measures, very, very important. So margin of safety and degree of operating leverage. So both measures, one is taking care of assess the upward potential, the other is for downward risk. Let me introduce the concept first. All right, so margin of safety. Let me draw a picture. It will become super clear. All right, so this is our CVP graph. All right, so you have sales or expenses. All right. Let's see, this is sales. All right, so and then this is all the expenses. All right, so all fixed or variable. Okay, so this is the break even. Okay, so this is a break even. All right, so one is in units, the other in sales, right? So this is a break even in units, and this is a break even in sales. All right. So now, suppose we are right here. This is where we are. Okay. So we are here. So basically, so have a little map like we are here right there. Okay, so this is how many units we produce and sell. And the revenue is there, total expense is here, so we are making profit. Alright, so this, the difference here is basically OI, right? So that's the operating income, correct? Now, what's the margin of safety? So margin of safety, you can also talk in units or in sales. When we talk in units, that's basically the difference of here. That's the margin of safety. So how much you can fall back on so that you are still in break even. Okay, so since you are here, so I have a large cushion to fall back on, so my sales can drop to a certain degree, I'm still break even. Okay, so that's basically the margin of safety we're talking about. Now suppose we are in so talking in sales, all right? So then so the margin of safety will be the difference between those two. So that's how much the sales you have to drop cause usually that's what the manager will talk about, right? So they will say, okay, sales dropped by 20%, 30%. So then you wanna know, okay, whether you are still in, okay, break even, okay? So then that will be the margin of safety. So this is the margin of safety in units, this is the margin of safety in sales. So that is, okay, so how you define the, the term. Okay, so you use whatever the expected units you're gonna sell for the next 12 months minus the break even. Okay, so that's where you are. Okay, you wanna, so subtract from, how far that is from break even. Now, the useful way to do the calculation is to calculate the percentage, so margin of safety percentage. Okay, so let me write it that way. Margin of safety in percentage. So you are thinking about, margin of safety as a percentage of the sales, the current sales. Okay, so then that will be, margin of safety. Okay, either in units or in sales, it doesn't matter. Okay, divided by the expected sales. Sales in units or in sales, okay, you have to be consistent. Either both are units or both are sales dollar, okay? So it can be, in units or in dollar, okay? So this is also in units or in sales dollar, okay? So you have to be consistent, units divided by units and the dollar divided by dollar. So the reason is, so the manager, when the manager says sales drop by 20%, they basically start from here, they say, sales go down by 20%. But you also wanna know what's the, percentage of this cushion relative to the sales, right? So if this cushion is, 25%, you say the sales is gonna, drop by 20%, you will say, whoa, we are safe, there's no problem. Suppose you are operating here, you only have, the cushion 5%. If the manager says, well, so next year our sales is gonna drop by 20%, you're gonna worry, okay? So then maybe the company will be getting into the, not break even. There will be a risk of, going bankrupt and everything, right? So then that will be a super risky scenario. Okay, so you want this cushion to be as big as possible. Okay? So that's margin of safety. Now let's look at degree of operating leverage. The definition, so this is less known. The definition is contribution margin divided by operating income. Alright, so that's the degree of operating leverage. Alright, so let me first explain how you use it. Alright, so now we talk about the sales can go up and down by 20%, correct? So now, so if the investor, whoever give the money, they care about the performance, right? So performance of the company. If you only say sales increase by 20% or decrease by 20%, that's not good enough. They want to know what happened to the bottom line. The bottom line is operating income. They want to see how do you translate 20% increase or decrease in sales into the changes in operating income, okay? So then, so usually with the introduction class, you can already do the calculation, right? So if sales, so here's my income statement. If you tell me sales decrease by 20%, I'm just gonna prepare a new income statement, then I'm comparing the operating income, then calculate a percentage. You can completely do that. But with the degree of operating leverage, we actually have a new tool. So this is how you're gonna use it. So suppose the degree of operating leverage is 4. I'm sorry, make it 2, all right? So let's see, a sales increase by 20%, all right? So now, this is equivalent to, say, operating income, all right? So because sales increase, operating income, of course, will increase. Sales decrease, your bottom line will decrease as well. Will increase by, 2 times 20%, that will be 40%. you can immediately quickly calculate this, okay? So if sales decrease by 20%, your operating income will drop by 40%. So that's how, all you have to do, just multiply this degree of operating leverage. That's all you have to do, okay? So that's how you use it. All right, so it's a good habit if you don't believe what I said, all right? So I'm gonna show you, okay, whether this is indeed the case. I'm gonna prove this to you, all right? So this is our operating income, is the original, right? So contribution margin per unit times units minus operating expense, all right? Now, suppose, okay, my sales increase or decrease, so we have the units, okay, will become, okay, so this can be 20%, right? So this will be 1 plus 20%. You can also have 1 minus 20%, right? So it doesn't matter. So that's basically the only thing, the sales change. Because when you increase the sales, your contribution margin per unit will not change, fixed expense will not change, all right? So now you have a new income statement. Now you use 2 minus 1, all right? So you get, this is okay, your change in operating income, right? So your new operating income minus the old operating income, you get a change. And then look at what we have here, all right? So fixed expense will cancel out. So let's say you have contribution margin per unit times units, okay? Times 1 plus 20%, and then minus contribution margin per unit, okay, times units, all right? So you have the contribution margin per unit as the common factor, all right? So you take that out, right? So that's how you have contribution margin per unit. And here you have, okay, 1.2 units, and then you have units, you get the 20% of units, right? So that's what you got here, all right? So that's the units times percentage, right, okay? You can also take the units out, that will work as well. So that's the common factor, okay, if it is easier. So then you get 1 plus 20% minus 1, then that will be 20%. Okay, so this is where the percentage coming from. All right, are we okay? So at this point, okay, I just, okay, simply do, okay, 2 minus 1. All right, and fixed expense cancel out. All right, so now, okay, divide both sides by operating income. So the change in operating income divided by the original operating income, that's your percentage change. Agreed, right? So on this side, you get the percentage change, all right? So that's that's a change in operating income divided by the original operating income. So that's the percentage change. On the right side, you have contribution margin per unit multiplied by units and multiplied by percentage. Okay, here I'm gonna use 20% so you don't get confused. All right, so, and then divided by operating income, correct? So then contribution margin per unit multiplied by units, that's contribution margin, total contribution margin, and divided by operating income multiplied by 20%. That's exactly what you have here. So now you get the change in operating income equals DOL times the change in sales. So 20% change in sales multiplied by DOL2, you get 40% change in operating income. That's where, okay, the relationship coming from. Are we okay? Question? All right. Now let me give you some explaining about operating leverage. So how many of you know the term financial leverage? You must have heard from someone. How many of you know know the term financial leverage? Yes?
It's like when they, it's like when you borrow, money, and then you have to, show them assets or something equal to about what you're borrowing, and then they can put, if you don't pay, the agreed upon amounts, every month they can take that from you.
That's the interest, right? Okay. Is financial leverage a good thing or bad thing?
Depends on the person.
Depends on the
If
person,
you're the one loaning the money out, it's a
Depends on
good
the
thing.
return.
depends on the return.
If you're the borrower, it's a bad thing, if you're the lender, it's a good thing.
So financial leverage in the firm setting is really about the structure of the finance, okay? So it's basically the relation between debt versus equity, okay? So equity, you put, okay, if you invest in the firm in the form of stock or equity, and you do not get the money back, right? So your return will be this dividend, and then hopefully the company is doing well, and then maybe in the liquidation, you get a bigger portion of it, okay? For that, you have, okay, if you invest in the company in the form of, okay, you loan the money to the company, and then you get a fixed return, right? So that's the interest, right? From the company perspective, right? And then especially, okay, for the equity holder, if you, okay, purchase any company stock, right? So you become the equity holder. From the equity holder perspective, when the company is doing well, you want the company be highly leveraged, okay? Because that basically means you spend very little money to invest in the company, you're gonna get a bigger return. But when the company is not doing so well, you do not want the company to be heavily leveraged, because that will put too much pressure on the cash. So I'm gonna show you, okay, simple example. You're gonna see that, okay? Which is important, all right? So firm one, okay? So you do not have to, okay, so this is actually, you're probably, okay, if you take, okay, finance class, you're gonna, okay, learn extensively. But actually, this is a simple idea. So from accounting, we can already learn this. All right, so let's say, okay, firm one have, okay, so it's a 500,000, okay, company. All right, so it's the total asset is 500, and firm one, okay, equity is a 500, debt is 0. Okay, firm two, again, 500,000 as the asset. All right, and debt is 250, and equity is 250. So this is a balance sheet, right? I'm doing introduction to financial accounting. Okay, which company? Okay, so if I calculate a debt to equity ratio, right? So you probably learned debt to equity ratio. What's the debt to equity ratio for firm one? 0. What's the debt to equity ratio for firm two? 1. Very good. Which company is leveraged? Firm two, right? Firm two borrow money, half of the money coming from debt, half of the money coming from stock. All right. So and then firm one, okay, completely okay, all equity. Now I'm gonna look at two scenarios. Okay. So the first scenario, if both company make money, all right. So so let me, okay. So just this is 10% interest rate. Okay. So this is borrow. Now, suppose, okay, both company, okay, make money. All right, so income before interest, all right? So both, okay, both company are exactly identical, okay? 100,000, I think it is 100,000. All right? Now, if I calculate income after interest, okay, let's not worry about tax, all right? So for firm one, that will be 100K, correct? Because there's no interest to pay. But for firm two, all right, so then you get 100,000 minus 10% of 250,000, correct? So then you have 75K. Am I doing correctly, right? So this is all I'm doing is subtract the interest. Now, because we are looking at this from the equity holder perspective as an investor, okay, you purchase the company's stock. So then the measure we are gonna look at is return on investment, but this is okay more in more detail. So it's return on equity. So that's the ROE, all right? So the return to me is 100K for firm one, but my total investment is 500K. So I'm getting 20%, correct? Now for firm two, all right, so the return to me is 75K because after interest, right? So that holder will have the first priority, so 75K. But then the equity I put in is also less, is 250. So I'm getting 30%. Everybody get that? So this is okay, when a company is paying money, is making money, because the debt holder, they get a fixed amount. Doesn't matter how much profit you make. You can make 100,000, 200,000, 150, doesn't matter. The debt holder is always getting 25. The rest of that will go to the equity holder. So that's why the higher the leverage is, the better for the equity holder. So the equity holder will prefer firm two, correct? Now, let's look at, suppose, so this is scenario two. I'm not making money, so this will be called income before interest. So instead of income, it become a loss, all right? So it's a negative 100,000, all right? So now, let's look at, for firm one, so I'm just directly calculate ROE. So then that will be negative 100,000, all right, divided by 500,000, right? So I'm getting negative 20%, sorry. Now firm two, all right, so then I have, lost 100,000, but because the debt is debt, right? Doesn't matter you're making the money or not, you're gonna pay interest. So then I have, 25, 250 times 10%, all right? So then divided by 250K. All right, so if you do the calculation, so this is a negative 125K divided by 250K, so then that's a negative 50%. All right, so this is the leverage, financial leverage. Financial leverage means, what portion of the debt, in your financial structure. When the company is doing well, you want the company, to borrow as much as you can, all right? So because of this, because the more money you borrow, the higher return to the equity holder. Now, for the, but if the company is not doing so well, you do not want the company to get into a high leverage situation, because the more money they borrow, and then the bigger impact that will be. So your return on equity will decrease, even more. So this is So bad scenario, you want firm one. Good scenario, you want firm two. Is that clear? So this is the riskiness of the financial leverage. So why do I talk about this? The reason I talk about this is because operating leverage is about the fixed expense versus the variable expense. All right? So that's why, because this is all about the cost structure, so that's why it's called operating leverage. And by the way, this is also a choice, all right? So the company can actually change their cost structure, by making, some kind of decision, operating decision. The same thing as the company can change their financial structure by making some kind of financing activity, So those are all the choices the manager can make. Now let me, show you, you see the similarity between the two. So let me go over, so quickly those examples. Okay, so I'm looking at firm one, okay? So the sales is 20, this is how many units, 25. So sales is 25,000, what's the selling price per unit? How much is the selling price per unit? Isn't that 10, alright? So variable expense 12,500, what's the variable cost per unit?
5.
That's 5, thank you. Contribution margin will be 10 minus 5, that's 5, right? So you use sales minus variable expense, you get 12,500, minus the fixed expense doesn't change, you get 10, okay? Now, when sales increase by 32, so that's basically 25 times 1 plus 32%. That's how you get the 3,300, okay? So once you have 3,300, the sales, multiply by 10, you get the 33,000. Alright, so this is why, the $10 is important. Alright, and multiply by 5, you get the 16,500. So you get a new contribution margin, but the fixed expense doesn't change, you get the operating income. And then look at the change here, alright? So the percentage is 4,000 divided by 10,000, so the change is 40%, okay? So 40% increase, because it's positive. So when sales increase by 32, operating income increased by 40%. Okay, so that's how you do the calculation. Decrease exactly the same thing, right? So except, so right now, so it's 25 times 1 minus 32%. So once you get the 1,700 times 10 times 5, and then same fixed expense, you get 6,000. So 6,000 minus 10,000, you get negative 4,000 divided by 10,000, you get a negative 40%. So that's a decrease in operating income. Alright, so that's so sales increase, operating income increase, sales decrease, operating income decrease. Now, introduce firm 2. The difference between 1 and 2, not on the top. So top is exactly the same. So that means selling price the same, variable expense the same. The only difference is the fixed expense. Alright, so fixed expense for firm 2 is 10,000. It's a lot bigger. Now let's look at if the sales increase, we remember this is a 40%, right? So this is a 40%. Now we do the same thing, 33. So now subtract 10,000, you get 65. So this is basically again 4,000 divided by 25. Alright, so you get 160% increase. Alright, so look at the difference. The only difference between firm 1 and firm 2 is on the fixed expense. Alright, so then you get, so 40 and 160. Now, so you can calculate the same thing with, decrease. So again, this is a 40% decrease. This is 160% decrease. So later, put the company, into the loss. Now, so couple of things, the one thing we can do is, let's calculate DOL, right? So DOL, for the operating leverage, so then that will be 12,500 divided by 10,000, so that's 1.25. Alright, so later you have 32% negative, multiply by 1.25, you get negative 40%. So you do the same thing for firm 2. DOL is 12,500 divided by 25. So that is, 4, sorry, 5. So this is 5, and then negative 32%, times 5, then you get negative 160%. See, you do not have to do all the calculation. Once you have this, you calculate DOL, you can directly calculate the impact on operating income. Okay? Alright. So this is basically, okay, how the DOL will help explain. Now you probably ask, okay, I'm using contribution margin over operating income. And that has nothing to do with fixed expense, where the fixed expense come to play. Alright, so this is basically, okay, so how you derive this. Okay, so DOL is contribution margin over operating income, correct? But contribution margin minus fixed expense equal operating income. That's our basic income statement, right? So contribution margin income statement. Then you can write this as contribution margin equals adding the fixed expense on both sides, operating income plus fixed expense. Alright, so plug this back into the numerator. So you have the operating income plus fixed expense divided by operating income. So you have operating income over operating income, fixed expense over operating income. That's where you get 1 plus fixed expense over operating income. That is your DOL, okay? So now you say fixed expense higher, your DOL will be higher, okay? And think of DOL as some kind of magnifying glass, right? So you basically, whatever changes you have in sales, you multiply by this DOL, then it will, okay, become bigger. Now, the immediate question is, what will be the lowest DOL?
Low.
What could be the lowest DOL ever? Isn't that 1, right? Because, okay, this part, fixed expense can be 0, right? When do you have fixed expense 0? Yeah, all the expenses are variable, such as you open a daycare, right? So you have a service, okay, firm, right? So you just rent the building, right? So that will be the rent expense, so that can be variable. And then you will have, okay, hire a few, okay, friends or helper. Then you can open a consulting firm or a daycare. So then you do not have fixed expense. When you do not have fixed expense, then this is 0, and then your DOL will be 1. But can you, okay, this cannot be negative, correct? Fixed expense, the lowest you can get is 0. So that's why, okay, you can never, okay, so the lowest DOL will be 1. So which means it doesn't get to, okay, magnify the changes in sales, right? So when you have DOL 1, if you have 32% of increase in sales, your operating income will increase by 32%. You do not have an increase, okay, magnified effect. All right, so, and then this is okay, so again, going back to the manager's decision, right? So you can, so usually for the firm, if you wanna look at, okay, so try to understand the percentage change, right? So economy is doing well, most of the company will increase their sales between the range of 30% to 40%, right? Then if you know what industry the firm is in, either labor intensive or capital intensive, you know how big of an effect those sales change on the operating income. You kind of get like, you wouldn't be surprised, wow, look at that company, okay, operating income increase, the bottom line increased by, okay, 60%. You won't be, okay, as impressive because you understand the effect of this, okay, DOL. Now, okay, between labor intensive and capital intensive, which company, okay, which type of, okay, business have a higher DOL? Which one have higher? Okay, what's labor intensive? What's the difference between labor intensive and capital intensive? How do we know a company is labor intensive or capital intensive? So wouldn't you wanna look at that company's, okay, expense or cost structure, right? If the cost, most of the cost coming from variable, especially for labor, right, labor related, right, so wages, then that will be labor intensive. In contrast, if the company's cost structure largely coming from depreciation of the machine, depreciation of the building, that basically means the firm is largely capital intensive, right? So things like, service industry, that will be labor intensive. Utility company, large manufacturing company, the airplane, manufacturing, the airplane, the shape, the car, so that will be capital intensive, okay? So now, given that understanding, which type of the industry have a higher DOL? Labor intensive or capital intensive?
Capital.
Capital intensive, right? Because you have a higher fixed expense, alright? So this will have higher DOL. So which means they are gonna if you have the same level of changes in sales, the capital intensive industry will claim a bigger jump on their changes in operating income. Okay? So then this will have a lower DOL. Okay, so this is basically how you have basic understanding. Alright, so we can use the degree of operating leverage to justify to assess the upward potential. Alright, so basically so how high can you go, right? So what's the best scenario you can get? But at the same time, we also need to evaluate the downward, right? So if the sales drop, and then are you gonna fail off the safety net? Okay, so that's the downward risk. We're gonna use the margin of safety. Now, so quite often the manager actually facing this type of decision, right? So their operating decision they try to make, especially for the long run, will affect their cost decision, cost structure. So especially if we try to replace machine, labor with machine, right? So this seems to be almost all the company are facing this kind of with the technological innovation, right? So do we want to use AI? Do we want to use more computer? Do we want to hire less people, right? So even Panera using so automated, right? So ordering system, right? So you go in, then you start ordering. You do not have to go to talk to a person. You can make your order. So then the labor is related to the variable expense, and the machine is related to the fixed expense. All right. So then, with this kind of decision, you reduce your variable expense and increase your fixed expense. Now, so now let's see whether which one is good or bad. I wanna kind of show you a scenario where you can actually use the margin of safety and the degree of operating leverage to make some kind of assessment. Okay, so this is a simple example. So I can kind of put all the things together. So fixed expense, so we get, so the the manager is making those two decisions. Do I use manual or do I use automated? The total level of sales, producing sales, the units is 10,000. We have selling price, variable expense, right? So notice the selling price stay the same. The menu has a higher variable expense, but the automated, because it's using machine, it has a higher fixed expense. All right. Now, the manager basically said, well, so the sales change. We are not talking about increase or decrease. We are talking about both, right? It can be going up and down 20%, or going up and down 40%. All right. So now, so how are we gonna? So the first thing we are gonna say, well, so let's look at the best case scenario. Let's calculate DOL. So to do that, so I need to figure out, so the income statement, right? So then we have sales. I'm gonna do, so contribution margin, all right? So I'm gonna do, so this is 20, and this is 50, all right? So I have 20 times 10,000, all right? So that's 200,000, okay? And fixed expense is 100, all right? So then operating income is 100,000, correct? So then DOL is just 200K divided by 100K, so we get 2, alright? And, automated, alright? So contribution margin is 50. So we have 50 times 10,000, so then that will be 500,000, alright? Fixed expense, 375, alright? So then operating income is 125,000, alright? So then we can calculate the DOL as 500,000 divided by 125,000, okay? So this is 4, okay? Now, we can assess, okay, upward potential. Okay, so upward potential is, alright, so I have 2 and 4, so this is assess upward potential. Alright, I'm looking at if the sales increase by 20%, menu will increase by, operating income will increase by, okay, so increasing sales, so this will be in operating income, so this will be 80% increase in operating income, alright? So if I increase, okay, sales by 40%, alright, so then that will be 80% increase in operating income, this will be 160% in operating income, alright? So I'm getting, okay, both numbers are higher when I have automated, right? So if my sales increase by 20%, okay, so then the automated will give me bigger booster on the operating income, alright? So in both cases. So operating, okay, so upward potential, so this went out, right? So automated. Now I have to worry about downward risk. So the downward risk, I have to look at the, okay, so the margin of safety. Alright, so then the way to look at this well, so is menu. Alright, so then I have the break even, which is, so break even, so that will be 100 divided by 20, right? So then that's a 5,000, okay? So then margin of safety, okay, so then that will be 10,000 minus 5,000. Alright, so we get 5,000, alright? So then do the same thing with the automated. Alright, so break even, 375,000 divided by 50, correct? So that's a 50 contribution margin per unit. So then that is, I can cheat a little bit, so 75. So this will be 75 units, okay, 7,500, and margin of safety. Alright, so it's 10,000 minus 75, then we get 25, alright? So now, the useful way, so this is basically the, okay, so where these numbers are coming from, alright? So 5,000, 5,000, 75, 25, okay? So now, okay, so I'm gonna calculate the margin of safety, okay, in percentage, alright? Alright, so then that will be 5,000 divided by the 10,000. So the 10,000 is the initial sales we have, right? So then we get 50%. So here I will have 25 divided by 10,000, and then we get 25%. Alright, so to evaluate the downward risk, right? So then I will have, okay, so if the sales decrease by 20%, alright, am I okay with menu? Okay, so am I okay if the sales goes down, okay, drop by 20%, am I safe at the menu? Yes, right, because, okay, I have a 50% cushion. If you only drop 20%, I'm good. So this is good. Okay, and the automated, am I safe? Yes, because I have a 25% cushion, I can drop 20%, I'm still within the safety zone. So this both are okay. But if I drop at 40%, all right, am I safe at the manual system? Yes, because 40 is still within the safety net 50%. But if for automated, it's 20, I only have 25% of cushion. But if my sales decrease by 40%, I'm not safe, correct? So that's why, okay, so it looks like, well, so from the downward risk, okay, so the manual actually gave me the, okay, a better choice. Now, how do you choose? So the decision will be based on if the sales change is 20%, which one do you choose? If the sales change is 40%, which one do you choose? What do you think? If the sales is 20%, up and down 20%, which system do you choose? I'm gonna choose automated because I don't worry about my downward risk, correct? So then my, okay, upward potential is, okay, the highest and the automated. So I'm gonna choose automated. But if, okay, the changes is 40%, up and down 40%, which one do you choose? That will be manual, right? So that's how you, because, okay, so because I'm not in the position to worry about the upward potential, I'm worried about survivorship. I make sure my downward risk is not too high. I cannot take the, okay, 40% down when I have automated. So that's why, okay, when I expect the future, the sales is gonna go up and down 40%, I'm gonna go with the safe route menu, okay? So that is, okay, how you make the decision. Any question? All right, so this is basically, I give you the, okay, analysis here, so you can, okay, read the discussion yourself. So this is basically, okay, everything I want to talk about for chapter 16. So give me, okay, 2 minutes. So I want to go over this question quickly. This is one of the homework question. Okay, so later on I'm gonna post, so I think the Thursday I'm gonna post the review notes and everything. So question like this, you need to know how to do it, okay? You really need to know how to do this. All right, so I'm going with the question first. I'm looking at fixed overhead, all right? So then, okay, so then I will have actual, okay, budgeted, and applied or standard. Okay, it doesn't matter, okay, so applied or standard. Let me use a standard instead, okay? So just try to be consistent, all right? So then, okay, so I wanna know, okay, what this number is, okay? So now, okay, so the information I do know, okay, so the information I do know is the actual number, okay? So this is, okay, 41,335. Okay, so I need to figure out the budgeting. So it's clear, right? So if I wanna know this, I already know this, I should calculate the budgeting. So the budgeting, everything is on January 1st. All right, so I'm only using the information on January 1st, which, okay, is basically this part. All right, so this part actually give you the curve. All right, so it's the overhead cost, is a cost curve equals intercept, which is the fixed overhead plus a variable overhead. Variable overhead is the SVOR, the variable overhead rate, multiplied by the direct labor hour, all right? So essentially, you are looking at a picture, all right? So you get, if this is a 10K, and this is, okay, overhead is 80K. If this is a 20K, you look at the overhead 120K, all right? So then the slope of this is SVOR. The intercept is the budgeted fixed overhead. One way you can do this is, well, so I can plug in 80K equal fixed overhead plus SVOR times 10K. And then 120K equals fixed overhead plus SVOR times 20K. Okay, you can solve two variable, two unknown. That will work too. So that, okay, so you have a 120 and 80, that's 40. So this is 20 and 10, so that's 10. So 40 divided by 10, you get SVOR, which is 4. So SVOR is 4, so that's what you can calculate, all right? So now, okay, so plug this back into any equation. So 4 times 10, that's 40. 80 minus 40, that's 40,000. So that's how you calculate the budgeting. So this is a 40,000, okay? So then you already can calculate this. Now, for variable, okay, so this, okay, so what about variable overhead? So this is a little bit, okay, have a little bit work. So you get a variable and then SVOR times AH and then SVOR times SH, correct? So then, okay, you wanna calculate this number, all right? So then you already know the actual. So the actual is 70, that's given. You already know SVOR, which is 4. So all you have to do is calculate AH. Now, the information you do know is, I know this variance. So this variance is efficiency variance 32. So that will be negative 32, all right? So given I know SVOR, I know AH, SH, it looks like I know the AH, SH difference. It looks like if I wanna calculate AH, I have to calculate SH. How do I calculate SH? I go back here, the standard fixed overhead is SFOR times SH, all right? And I also know the difference here is 1,750, okay? So I know this number, I know the variance, I can calculate this. And then I also know the standard fixed overhead is SFOR times SH. Now, the question is, how do I get SFOR? So then that will go from overhead rate equals overhead cost divided by direct labor hours. Overhead cost is the sum of fixed overhead plus variable overhead divided by direct labor hour, all right? So then that's direct labor hour, fixed overhead divided by direct labor hour plus variable overhead divided by direct labor hour. And the first one is SFOR, and then the second is SVOR, okay? So that is, okay, this is, okay, should be the common concepts you should understand, okay? So it's not, okay, you don't have to, okay, it's just basically, if you understand the concept of overhead cost, overhead rate, you should be able to do this. Now, the overhead rate is given 6.25, all right? So that's given here. Now, 6.25, SVOR is 4, so SFOR will be 2.25. That's where you got the SFOR is 6.25 minus 4 is 2.25. So you get SH. Once you get SH, you plug in here, you get AH, that's how you get the variance, all right? So the only thing you have to pay attention to is, this is a January 1st information, this is the January 1st information, okay? You need to know all the, know this too. Now, another thing which a lot of people get confused is SH. SH is standard unit hour per unit. So this is basically a standard quantity multiplied by the actual units. So that's the definition, okay? So this is from the standard cost sheet. You need to know, okay, so once you get SH, you know the actual units, divide, and then you get a standard hour. So that's basically where this number coming from. So you essentially only have to know those 3 things to solve a problem like this, okay? But the key thing is you have to put everything in front of you. So that will become clear, right? what you know, what you don't know. If you use a formula, it's a little bit difficult to say. Okay? So that's all I wanna say, okay? So, I will see you on Thursday.